One Up on Wall Street Part 4, The Hidden Formula of the Perfect Stock. In Part 3 we saw that trying to predict the market many times takes an investor far from the company and close to anxiety. Peter Lynch explained through the cocktail theory how the mood of the crowd changes, and then the path opened to understand companies in slow growers, stalwarts, fast growers, cyclicals, turnarounds and asset plays. But at the end of Part 3, a dangerous question remained left over. If we understood the category of the company, does that mean we should buy the stock? Imagine an investor is standing in the crowd of the market. On all sides there is the voice of hot stocks. This is the next big thing. This will change the future. This opportunity will not be found again. His heart says buy right now. His mind says stop and see. And the fear is that the shiniest name might become the biggest loss. Right here begins the mystery of Part 4. Because Peter Lynch explains that categorizing the company is necessary, but the story is not complete yet. The real question is how the company's earnings will grow further. If this answer is not clear, then the entire story of the stock can become just imagination. The stock price is many times loud but earnings speak slowly. And in the long term this very slow voice decides whether the business is truly strong or just the noise of the market. A company's share price can go up on hype for a few months. But if earnings are not increasing, it becomes like a building built on air. Peter Lynch's focus was right here. He used to ask, how will the company earn more money? Just, the brand is good, or the product is famous is not enough. There can be many paths for a company to increase earnings. It can reduce costs, raise prices, go into new markets, sell more to old customers or revive a weak business. Reducing cost looks the simplest, but it is not always simple. If the company reduces waste, increases efficiency and improves the supply chain, profit can truly improve. But if cost-cutting spoils quality, weakens employees or ruins the customer experience, then short-term profit can become long-term damage. The second path is raising prices. But not every company can raise prices. Only that company can raise prices whose product has trust, habit or necessity. If the customer gives extra money without thinking much, then the company has pricing power. And pricing power many times works like a hidden moat. The third path is going into new markets. If a product running in one city creates demand in another city, another state, or another country too, the growth runway can become long. But expansion does not happen just by drawing a line on a map. In every new market there is a different test of distribution, local taste, competition and execution. The fourth method is selling more in the old market. Meaning the same customers, the same area but increasing sales through higher volume, better packaging, repeat purchase or new variants. Many times a company does not need a new country. It just has to serve its existing customers in a better way, and a new layer of profit opens right from there. The fifth path is closing or reviving a weak unit. Inside many companies, one part earns money, another part eats money. If management fixes, sells or closes the loss-making unit, overall earnings can suddenly look better. But this is meaningful only when the change is truly sustainable. The sixth path can be acquisitions. A company can show growth by buying another company, but this path demands the most caution. Because every acquisition is not growth. Many times it is management's ego, an expensive deal, or entry into a business that the company does not understand at all. Right here is the first turning point of Part 4. The perfect stock is not the one whose name is heard the most. The perfect stock is the one whose earning story is understood. But Peter Lynch's twist is even more interesting than this. According to him, the perfect stock often does not look perfect at all. It can be boring. Its name can be dull. Its work can be ordinary. And people in the market, instead of getting excited looking at it, move ahead. This thing seems upside down. Because we naturally get attracted towards shiny things. But in investing, many times shiny things invite the crowd, and the crowd shrinks the returns. Analysts can ignore a company with a dull name. Fund managers do not like to show it in presentations. The media does not make loud stories about it. But in this very silence, opportunity can hide. If the business is good and the price is reasonable, a boring name can become an investor's friend. Peter Lynch liked businesses that do boring or even disagreeable work. Like cleaning, waste handling, small industrial parts, or things that common people do not want to talk about. Because in such industries there is less glamour. When glamour is low, competition can also be low, and market attention also comes late. A no-growth industry can also sometimes be interesting. It sounds strange, but if growth in the industry is low, then the crowd of new competitors also comes less. In such a place, some strong company can quietly take market share. The industry remains boring, but the company steadily keeps getting better. Another hidden signal is a niche business. If a company holds a strong position in a small but necessary segment, it can have a small empire. This empire does not make newspaper headlines, but customers are unable to replace it. And this is the quiet power of repeat business. A perfect stock often has a product that people buy again and again. Everyday use, recurring demand, and habit-based purchase can give stability to a company. If the product's demand is not a one-time thing, but returning again and again, the business needs less energy to find customers again. Peter Lynch also liked companies that, instead of selling technology, made their business better by using technology. On a technology seller, competition and hype can be higher. But a technology user can quietly build an advantage by reducing costs, increasing speed, and improving profits. Spin-offs were also interesting places for Lynch. When a big company separates a small part of itself, the market can ignore it. Many investors do not understand a spin-off. They sell it because it feels small, unfamiliar, or boring to them. But right here, an investor who does research can get an opportunity. Insider ownership is also a signal. If management or insiders have a meaningful stake in the company, their interests can be aligned more with shareholders. But one should not be happy just looking at insider ownership. The real question is, are insiders growing the business or just maintaining control? If a company buys back its shares, this can also be a signal. If the stock is undervalued and the company reduces shares, the remaining shareholders' portion can become stronger. But a buyback is also not a blind positive. If the company is doing a buyback at an expensive price or showing off by taking debt, the signal becomes weak. The secret of the perfect stock is right here, that every good-looking point needs context. No single factor can make a decision alone. Now remember the thing from part 3. A good product is not a good stock, because how much the product contributes to the company's total profit, it is necessary to understand this. A product like Pampers can be popular, but if the parent company is very big, its impact can be limited. That is why an investor has to go beyond the popularity of the product and look at the company's economics. How much are sales, how are margins, how much is profit contribution, and how much growth is left. Now comes the what a deal question. Finding just a perfect business is not enough, the right price is also necessary. If a great company is found at a very expensive price, the return can be ordinary. If an average company looks cheap for the wrong reason, it can become a trap. Numbers like the PE ratio can help here, but do not make them God alone either. A low PE is not always cheap, and a high PE is not always expensive. If earnings are going to fall, then a low PE can also be an illusion. And if growth is real, then a slightly higher valuation can sometimes be justified. But the investor will have to look at the story and valuation together. Story without numbers is fantasy, and numbers without story are an incomplete photograph. Now let's move to the other side, towards those stocks that Lynch tells us to avoid. And right here stands the market's shiny trap. The hottest stock in the hottest industry. This phrase sounds like a dream, but Lynch considers it risky. Because in a hot industry, attention comes very quickly. From attention comes competition, from competition comes pressure on margins, and then the dream gradually becomes a crowded trade. When everyone is saying that this is the future, then the investor should be the calmest. The future can be right, but the price might have already run ahead of the future. Another trap is the next big company. The next Microsoft, next Amazon, next Tesla, next anything. This comparison sets fire to the imagination. But every next does not become like its original. Many companies market only in the shadow of names. Business reality is different. Whisper stocks are also dangerous. These are those stocks in which the story is very exciting, but earnings are not visible anywhere yet. Someone said a big deal is coming. Someone said there is secret technology. Someone said there is inside news. And the investor buys fantasy before facts. Companies with exciting names can also become traps. If words like technology, bio, space, digital or future are in the name, people assume that the business will be just as powerful. But the name is branding, not proof. In the market, many times the name runs first, and profit does not come even later. Lynch also cautions against diversification. Diversification is a good word, but when a company moves away from its core business and starts buying unrelated businesses, value can be destroyed. If a strong company buys a new industry just because it has cash, the investor should ask, is management a wise capital allocator? Customer concentration is also a big risk. If a major portion of the company's sales depends on a single customer, that customer can control the company's destiny. Today there is a contract, tomorrow it gets cancelled, and the entire earnings story can break. Therefore, understanding dependency in middleman-type businesses is necessary. Debt is also a hidden danger. The growth story can be beautiful, but if the balance sheet is weak, even a small problem can become a survival question. If the company is not earning profit, is burning cash, and is selling only promises, then the investor should look at oxygen before excitement. Management's language also gives a clue. If every year there is a new dream, a new project, and a new big announcement but earnings do not come, then caution is needed in the story. In the modern market, this danger has increased further. Social media can make a stock an overnight hero, but a business does not become strong overnight. That is why the mirror test from Part 2 works here again. Are you looking at facts or borrowing the crowd's confidence? Professional investors many times come late because their system is slow. Beginners many times make mistakes early because their emotions are fast. In Lynch's framework, an intelligent investor is one who escapes both traps. Neither blind delay nor blind excitement. Now imagine there is a dull company. The name is boring, the product is ordinary, there is no glamour in the industry, analysts' coverage is low, but earnings are steadily increasing. Management is applying money wisely. Debt is under control. Customers are repeating. Insiders hold a stake. The price is still reasonable. This company will not get applause at a party. But in investing, more important than applause is the silence of compounding. A perfect stock is often like that friend who is not loud on social media but remains reliable in difficult times. But caution is necessary here too. Every boring company is not perfect. Some are boring because there is truly no growth in them. Therefore, considering boredom as quality is a mistake too. A perfect stock can be boring, but a boring stock does not automatically become perfect. An investor has to look at the company's category, earnings path, balance sheet, valuation, management, and industry position combined together. If it is a slow grower, keep dividend and stability expectations, not a 10-bagger dream. If it is a stalwart, think of a measured return at the right price. If it is a fast grower, look at runway, margins, and expansion discipline. Do not get excited just hearing high growth, because the speed of growth sometimes slows down suddenly. If it is a cyclical, understand the cycle. Do not consider peak profit permanent. Otherwise, a stock looking cheap can become an expensive lesson. If it is a turnaround, look at survival. Is debt manageable? Will cash remain? Is management truly solving the problem? If it is an asset play, understand the real value of the asset and the unlock trigger. Just the story of a hidden asset is not enough. How value will reach shareholders is also necessary. The satisfying payoff of Part 4 is this very thing. Before searching for a perfect stock, an investor has to learn to recognize imperfect stocks. Many times, money is saved not by buying good stocks, but by avoiding bad excitement. And saved money becomes the strength for the next right opportunity. Peter Lynch's message is clear. The stock looking best in the market is not always the best. Sometimes the real deal is hidden in those names which people do not even like to speak in presentations. But now the story is going to go into another deeper room, because recognizing a perfect stock is also not the final step. Now the investor needs facts. Quality of earnings, PE, debt, cash, inventory, growth rate, and those small numbers that can make the story true or lie. In Part 5, this very test will open. There we will see how Peter Lynch used to catch a company's story through numbers, which famous numbers save an investor, and which attractive stock can turn out to be weak from the inside. Because the most dangerous moment in the market is when an investor says, "I have found the perfect stock," but he has not even asked yet whether this perfection is true, or just the shine of the story.
If this video has taught you something new, or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible. But in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.